Welcome to this my video. Today I am talking about an important concept of financial accounting, which is bad debts. What are the bad debts? Bad debt is an amount originally receivable from a debtor, but now it cannot be recovered due to some reason. It's a simple definition. A business has sold some goods of say let's say value of rupees 100,000 to a customer, and the customer later on refuses to pay rupees 10,000 out of that 100,000. Now that rupees 10,000 which he refuses to pay will become our bad debts. That is, this 10,000 cannot be recovered from our customer. So we need to record this transaction of bad debt in our books. So how can we record this transaction? It's a very simple. We assume some data that rupees 10,000 cannot be recovered from a customer. Now what we will do in our books, we will debit bad debt account with rupees 10,000, and then we credit our customer with rupees 10,000, because it has been determined that these 10,000 cannot be recovered from the customer. Now practically in exam question there are different scenarios which the examiner can put in front of the students. Let's discuss what he can ask and what we have to do there in the examination hall. He will give you a trial balance. There will be a figure of, let's say, trade debtors valuing 100,000. This will be of course on the debit side of the trial balance. Okay, and please remember this. This is the scenario 1 in which the examiner gives the figure of trade debtors in the trial balance and provides some additional information below the trial balance related to the bad debts. And what is that? He can write that a customer has refused to pay rupees 10,000 due to him. Okay. Now what we will do in our books while preparing the financial statements, we will simply write trade debtors in the balance sheet, pick up the figure of the trial balance, which is 100,000, and deduct rupees 10,000 from this 100,000. A value of 90,000. We will put this 90,000 in the balance sheet as a trade debtors because rupees 10,000 cannot be recovered from the customer. So what is the rule? Rule is that we have to record the figure of good trade debtors. Good trade debtors mean the debtors which can pay their dues. So to reach that figure, we have to deduct the amount of bad debts from the trade debtors. Okay, this is the case 1. Where the trade debtors are presented in the trial balance and the bad debts are presented in the notes, the financial in the notes below the trial balance. Now come to the case number 2, which is what the examiner does. He will give you the figure of trade debtors in the trial balance as well. On the debit side, rupees 100,000. And he will show you the figure of bad debts of rupees 10,000 in the trial balance too. And there is nothing provided in the notes or additional information below the trial balance. So you can see the difference. In the first case, the examiner provided the trade debtors figure in the trial balance and the information about the bad debt in the notes below the trial balance in this form. While in case 2, he provides trade debtors in the trial balance as well as the figure of bad debts in the trial balance, and no information is provided in the notes below the trial balance. Now in this case, what we will do is, as you all know, that we place the trade debtors in the balance sheet in the asset sides. So what we do is we will write the trade debtors figure in the balance sheet. Now remember, we will write the figure of trade debtors which have been provided in the trial balance, which is 100,000. And as the bad debts are also provided in the balance sheet, trial balance, it means that it has already been deducted from the trade debtors. So what what we have come to know that uh, the actual debtors was rupees 110,000, out of which 10,000 have become bad debts. So before finalizing the trial balance, we have created the journal entry of the bad debts and reduces the amount of debtors from 110,000 to 100,000, and consequently the amount of the bad debts are also written in the trial balance. So in this scenario, this is the simplest and easiest to understand. In this scenario, we don't need to deduct the amount of bad debt given in the trial balance from the amount of the trade debtors given in the trial balance. They have already been adjusted. So what we do, we will write trade debtors as 100,000 because these are the good debtors. And in the profit and loss account, we will record bad debts as rupees 10,000. In case 1, we also write the bad debts in the profit and loss account as rupees 10,000. So in this today's video, I am showing you the first basic concept of bad debts with two scenarios, with two cases. In the next video, I will discuss with you some other possible scenarios in the case of the bad debts and the provision for doubtful debts and the provision for discount on debtors. So for this video, let's go through a real quick recap that there is two there are two cases. The case number 1, where the trade debtors figure is given in the trial balance and the figure of bad debts is provided in the notes below the trial balance. In this case, we have to adjust the bad debts from the trade debtors. And in the case 2, trade debtors are given in the trial balance and the bad debts are also given in the trial balance, and there is no information is provided in the notes below the trial balance. So in this case, the trade debtors are already adjusted and the bad debt entry is also made. So that's it for this video. I will come up with the second video on this topic in coming days. Until then, goodbye, take care, Allah Hafiz.